Good day, guys. Welcome back to the classroom. So today, I'm going to be your tutor and at the same time, your mentor and advisor, right? So on today's topic, we're going to discuss weekly rate expansion or the top-down analysis. Majority of you suggested I explain this topic or I teach this particular topic, which is my reason for coming to conclusion to make this video. So at the end of this lesson, you're going to learn top-down analysis and how I actually go to the market to make analysis on higher time frames. And the most interesting thing about this particular uh, concept I'm going to discuss is that it works on every asset that you can think of. Currency pairs, commodity, it works very perfectly on any pairs. So basically, this is gonna be from the higher time frame perspective, and in this particular video, we're going to focus more on higher time frame, which means that even including our entry techniques. So we're not going to be moving to lower time frame for entries. The analysis is going to be on higher time frame. Do you understand? Specifically for swing traders. And for day traders, they can actually utilize this idea in their trading style and also to get directional bias. When it comes to tradings and technicals, I'm always more specific and I'm always talking about reality, not what I feel like people discuss or people suggest. Something I have experienced, that I've tried, and that I've seen that this works many times. You understand it? So let's get started. So looking at this pair NZD-USD, I've been using EURUSD and EURUSD and GBP-USD for most of my videos, and whenever I'm even trying to explain something, I usually pick EURUSD or GBP-USD. So I decide to at least change my selection today. So I'm picking NZD-USD. Basically I like USD close, so that's my reason for picking this, and I believe the NZD-USD has a very good price action too. Right. So I'm going to first paint a picture of what I will be explaining in the chart and what we'll be expecting. Right? How do I make this analysis? What are my expectations? Do I just mark a POI and wait for market to get in? If I'm going to do that, how do I do it? Okay. Now, the best way to trade, right, is when market is approaching a draw on liquidity. We all call draw on liquidity magnets. If believe they have an invisible magnet for price, which means that when you have a draw on liquidity at this particular level, it means that markets will always want to draw it to that particular level, because what? Their liquidity at this level, and it's obvious that a lot of liquidity there, right? So markets will always at this particular level. Do you understand? So now, when you have markets that is close to draw on liquidity, it's actually the best way to trade. And if you think about higher time frame and lower time frame, the advantage of higher time frame is that we can always expect what is a very large range expansion. Do you understand? So, for example, now, if this is a market I'm trying to trade, and we are here, and market is approaching this level, this level is our draw on liquidity. You know that you would, if this is like a 1 hour chart or a 15-minute chart or 5-minute chart, you wouldn't want to look for a trade opportunity here because the range that market is going to cover, the distance from this level to this level might even be less than 20 pips. Do you understand? The distance between here and here may be less than 20 pips. And you know that if you want to now take a trade, before you know it, that you need a confirmation, before you know, market is the range is already reducing. Before you know, you see that we have 15 to 10 pips to target. So you would not want to take the trade. But on the other hand, on higher time frame, if market is close to draw on liquidity on the monthly and the weekly, even if it is just a single expansion of candle that is going to play, we could have 100 pips on that candle, even if it is just weekly too. And even if it is daily, we still have like 100 pips, 70 pips. Do you understand? And on monthly, you might even have like 500, but you know that we are very close to drawing liquidity. So that is why I said it's majorly for swing traders, and this particular idea, this particular logic I'm going to explain works perfectly on higher time frame because of the range expansion. Do you understand? But you can use it if you have something like this on higher time frame. You can use it to get the idea of the direction of the day. Get me? So now, I like to trade when market is approaching an obvious draw on liquidity, right? So if this is a liquidity, this is a obvious level of liquidity, then I would always want to trade when market is almost close to it. So I can just look for a single trade to take that draw, but it's going to be on higher time frame so that this particular expansion would give me enough of what I want. Then it's going to cover a very large pips, which I need to make my money compared to what's on lower time frame. So when market is close to a draw on liquidity, the range of that, you always have impulse correction, impulse correction. This particular correction pattern is where you get your entry to take the liquidity and your out of the market. So most of the time, you're going to be using any available liquidity as a as a point to look for your own trade. We always have impulse correction, impulse correction, and every single time market takes a high or a reasonable high, market is going to draw, is going to reject. The reason why I'm saying this is because we're talking about higher time frame this time. So you can imagine market going above the previous daily weeks or months or days. So definitely we want to see market retrace. So this retracement is where you're gonna time your entry so you get your reward, your draw on liquidity smoothly. Do you understand it? So this is like the perfect approach when you are trying to make analysis on higher time frame, we are trying to look for daily buyers, weekly buyers. Do you understand? So now let me go to the chart so that we can discuss the reason why we're here. So if you look at this particular chart, this is the monthly time frame of NZD/USD, and we can see from just this little price action that it's a bullish market. Bullish in the sense that we have what higher highs and what and higher lows. See it? Impulse, correction, right? Impulse, correction, and impulse. So basically, we're going to be trading off what a discount level. Do you understand? So if this is our impulse to here, that means market have to return back to a discount before market expand. So we have this whole high to this particular low as what? As our range. Which means that if we need to measure it, the middle is going to be something like this, right? Like 50% of it. So we can always expect market to expand for 50%. Do you understand? Now, if you look at what happened here, market only returned back. This is the only available reference point you can think of here, which is what this fair value gap. Do you understand it? So market can enter this fair value gap at deep discount, and we can expect market to expand, right? So, and if you look at all of this, is like the level of liquidity we can target first, right? You can think of this as level of liquidity to target, because after market enters this particular level at a discount on the monthly time frame, then you can see the market expanding to the what? To the upside. So definitely you can see how market has traded here well, and can know that you can obviously see that this high is a level of liquidity in the sense that there was a mitigation, and if you understand the meaning of low resistance liquidity one, you understand that this particular level is now a level of liquidity because what it has been mitigated, right? And market has already reached a what? A discount. You understand? So this is like a level of liquidity that we can target first before we keep moving higher. Because why? Because obviously we are discounts. You understand it? So now if we move to weekly time frame, you can see that markets actually still got here, and we've seen the market expand. So these particular highs are what? I draw on what? On liquidity. So let me just move this box first to this particular high. They are what? They are the obvious draw on liquidity. Do you understand? So, but if we also look at all of these highs, you can see that these are also draw on liquidity, because it's more or less like a thin line phantom. You understand it? You can see it's something like a pretty thin line phantom, right? I don't know why this is giving me arrow. I'm not interested in arrow. You can see it, so seeing the markets behavior. So more or less like these are all level of liquidity. You get my point? So now we're going to make it more realistic and reasonable. in terms of expansion and expectation. So now, okay, let me break this. Where is this? Let me break this away. So now, if you look at this now, this house level of liquidity that are obvious, right? We put it obvious, 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 draw and liquidity, right? Because these are relatively equal highs, right? These are relatively equal highs. And before all of this, we have this high and we have this high. We have this high and we have what? We also have this high, and then we now have what? The relatively equal highs. So this is what we are seeing on the weekly chart. And you know where we are coming from, discount on the what? On the monthly time frame. So we have this to be our draw of liquidity. And this is weekly candle, right? If you can see this as draw on liquidity, and you can look for, but even if it is all of this single eye, you want to be using as your draw on liquidity because they are also draw on liquidity, right? I'm only picking this because these are relatively equal eyes, right? But all of these are also draw on liquidity, and they are the liquidity you will use to what to target the next. We will use this liquidity to target this, and we'll use this liquidity to target this. It's always like that. What do I mean by we use one liquidity to target another? What I'm trying to say in essence that when markets take a reasonable liquidity level, do you understand it? Market is going to retrace, correct, before it expands again. Do you understand? And like I said, this is on the higher time frame, and higher time frame levels of liquidity are more strong, so they can actually reject deeper before market expand. So when market take this particular high, then we expect market should retrace and take this liquidity. But when market take this particular high, market will also retrace and will take this liquidity because all of this, they are what? They are like external range on their own. If we are going to be using this leg as our both external, as our highs and low, definitely high above here is external, considering this leg. So which means when market take external in, the same market will return back to internal range and expand again. If you take this particular external range, right, the same market will do what to retreat and expand again. And market is going to come for this particular one to retreat and expand again. So that is basically how market moves. So just for example now, this particular high too is a level of liquidity, which means that this high, right, this high is a liquidity to take this particular high, which means that if we want to look to, if this is our draw on liquidity, this is what you want to trade. So I think we would have a trade here. I'm trying to change this. Why is it giving me, give me normal? Yes, normal. I'm giving me how, see how style, visibility, coordinates, text, style. Okay, normal. Yeah, cool. So the market took this particular high, we expect market to definitely retrace back to what internal, which is like a fair value gap or an imbalance. And we have this here. Now, look at it. You can see that immediately market entered here, we've seen the market give us a new swing, which means that if we want to target here, we've had this particular swing inside this inefficiency. You understand? This is like institutional order flowing to do. So we've seen this, and from there, we can predict to take this particular high, right? So, and after this high, we have this high, and we now have this high. So this is our draw on liquidity. So, and we are close to it. So a lot of people will also be looking to sell here. That is why once market gets here, we might always see a shallow retracement for market expand. Do you understand? So these are levels of liquidity, obviously. Do you understand this? So this is one, this is one. So, and like I'm saying, the best is what? To use one liquidity to target another. So when the market do this, so market is inefficiency, and we have the market expand, take this particular high. Let's check that. You can see. After this candle, we have the market take this particular high, the market return back to this particular candle, or to what? To the mitigation block here, or from here. We anticipate the expansion to take this particular high. And you see that. You see? So immediately we are expanded above this particular level of liquidity, right? Immediately we expanded above here, then we also expect a retracement to come and take this particular. You understand? Because this is the level. So definitely in this particular range, we see another trade because this is like another discount after market take this particular high, then we need this one to get taken out. So basically, I can say we should think of here, this should be enough placements to take that. Good. You can see. Okay, go here. And market took this particular high. So now this high will be used to do what? To take this high. It is pretty simple. One liquidity to target the other. One liquidity to target the other. This liquidity to target this one. As the market return here, the market expanded here. So this liquidity now to target our inefficiency. I need to target our draw on liquidity or relatively equal high. Again, so if you go to daily time frame, let me remove this. Yeah, because even all of this on daily time frame, I always anticipate because this particular one actually happened from this particular mitigation block. So I can go here and see this low to the mitigation block, market expanded, the market returned back to this another mitigation block, breaker block this time to take the what? The next liquidity. And after that, we've seen this market expand down again. So we shall know that we are coming for this particular high. So if we play on, yeah. So same market return back here. This particular range, you can see it is always from the previous range, you get the expansion, previously you get the expansion. You understand? Because it's more or less like market is bullish and market is close to doing liquidity. But if you look at what is happening here, it's more or less like market is already doing higher highs and higher lows. So it's a low, higher highs, higher lows, higher highs. There's another higher lows, another higher high. So if you want to time your entry, then it should be the nearest level, or you can use the whole of this mitigation block or quicker block rather. And one thing I always do is that you have to always allow your trade to breathe. Do you understand? So me personally, when I swing trading, I usually leave enough room for my trade to actually breathe. So if this is my entry point, I may end up putting my stop loss below it. Do you understand it? So I will calculate it to be there. So basically, you can just get this from here. Maybe stop loss is level. And then if you look at it, is it reasonable enough? This is the what we are talking about. So yes, 3.68. Do you understand it? And look at it. It's just quite simple. We have dual liquidity. Market is already here. We have dual liquidity. Market is already here. And even this trade is it's even easy for anyone because it's more or less like you have what is it called? You have your trend line around this level and market broke above the trend line. And from there, you're trying to take all of the raw liquidity. So when raw liquidity is close, you can imagine now this is like a daily time frame. Now imagine if this is like 15-minute time frame, and this is your draw on liquidity, and this is when you want to take your trade for 5 minutes. At the end of the day, this might not expand more than like 15 pips or 20 pips. Do you understand it? But this we're on higher time frame, on daily time frame, do you know how much of pips that will be? Let me check. Let's take this one here. Let me see, 362. You understand? 362 pips when you're already close to what to draw on liquidity. And you've seen that every ice gets taken out to what? To take the next eye. Right from here. To this, to take this. To this, to take this. And now this, to take this. So this will be your trade. Right? So if you play it simple, this is like how many weeks? It will be like how many days? I don't care how many days it is, but basically, this is how I trade on higher time frame. I look for a trade that is very close to draw on liquidity. Do you understand it? I understand what is going on in the structure. Then I can take the trade. This is why I said this particular pattern will work on any pair you can think of. It will work. Look at it now. You don't need to rush expansion when you're taking the higher time frame. Look at this now. We've seen markets coming low, and we've seen all of this low as draw on what? On liquidity. We've seen it as draw on liquidity, right? We've seen it as draw on liquidity. This one too. Seen it as draw on liquidity. So what do you think happened? Again, this one now, I didn't even plan this, just saw this now. You see it. They took it and they use it to take the next one. Take this and they use it to take the next one. You can see it. After this, the market will turn back inside fair value gap, just like what I saw here. Understand it? Just above this particular high. Those highs are weekly candles, so they are levels of liquidity on their own. You understand it? You can see it. Just above it and the what? You took the low and you're out of your trade. Do you understand? So even if it is from here, you're already seeing that this is your draw on liquidity, and market already took this low, and you expect this to happen after this candle from here, tapping your trade, and what you're out of it. From this particular, let's say you want to enter from here after a break of structure, or after this break of structure, you retracement back to this bearish order block. If you should measure from this bearish order block here, and even go a sniper with this particular low, this is 133 pips. You can understand it. And this is daily time for 133 pips in just for 2 days. This is the first day, market will turn back to this other block, right? First day, second day, just 2 days, and you're out of it. Why? You are close to drawing liquidity. And why are they drawing liquidity? There are levels of low resistance because they have been what? Mitigated. If you backtest, it's the same thing. The same thing that happened here, same thing that happened here. The market is close to drawing liquidity. Study what is happening here. You can know what fastly the hand. Simple. You understand that? So it is very simple. If you go on the chart, you will always see trades like that. When market is close to draw liquidity, you can look for what the way to enter your trade. Very simple. So you can backtest more on your on your own, right? And when you understand that, you will see that trading will become more easy for you in terms of direction. Do you understand it? So you can just go to weekly time frame, right? Look for pairs that are close to draw on liquidity, and you wait for it to perfectly set before you do what? You take a trade. Just you can see that all of this, they created what? A breaker, a mitigation, they turn back to the mitigation, then expansion. So they created a mitigation, they turn back to the mitigation, expansion. In this one, too, they created a what's mitigation by from higher highs and higher low structure. You understand? And turn back to and expand. It's as simple as that. So if you are doing like that, if you are actually making your analysis this way, you'll be making a lot of money. I said we're going to focus on high time frame. That is why I'm not even going to daily time frame. Maybe the second episode, going to talk about how you can use those patterns on lower time frame. Can make analysis too. I can also use it to make money, fast money. That is what I use as my own bread and butter. I might not get more than five, I might not get more than 10 to 15 pips, but I'm very sure that the draw liquidity might be feasible for maybe on 4 hours or 1 hour. And I'll just wait for perfect trade and take it. Do you understand? But I like it more on higher time frame because it is more logical. You are close to draw on liquidity, and you know that market is always moving to the nearest level of liquidity. So why not calm down, time it, get your trade, and hold to your TP. Very easy. Do you understand? So this is what I have for you today, and I hope you guys like it. Right? If you enjoyed this, drop a comment. So consider the second episode. So next time you are trying to make your weekly analysis, monthly analysis, go to the chart, look for a market that's close to draw on liquidity. Do you understand it? A market that is close to draw on liquidity. And once market takes any of the previous highs, just like this, we have this high, we have this high, we have this high. So when they take this, you can use this to facilitate your entry. When they take this, you can use it to facilitate your entry. They take this, you can use it to take this high. Do you understand it? Simple. Just like this particular one too, for this bearish market, that all of this lows at liquidity, take this, if you use it, a mitigation to take what? This low. Take this particular low, use it internally to take what? This low. Do you understand me? But when they are close, not when they are still high. Because when they are still high, market might definitely be doing a lot of things. But when you are still close, it will be very, very quick. Do you understand it? So that is what I have for you. And that is how I make weekly analysis, monthly analysis, and also for daily buyers. Do you understand? But I think we'll talk more on daily buyers in episode 2 on this what is it called? Weekly expansion, and also draw on liquidity. Yeah, so I see you guys in the next video. If this is your first time, you are welcome to the channel. Go through my channel. The few videos I have is enough for you to be a profitable trader. Trust me. Just go through them, put your charts, practice, and make money. That is what I mean. I'm not wasting my time here for nothing. I'm giving you guys my time to record this video just to make sure that you guys are doing, and I want a positive feedback from you. So basically, this is how to do analysis on the monthly, not just about you have a high, you mark liquidity, when you mark liquidity, you mark your PO, and not every time you trade that way. Why not trade to take liquidity instead of marking liquidity and your PUR? Then trade to take the liquidity. You have this liquidity. While this liquidity is there and you're marking another high, why not trade to take the liquidity? Because liquidity is like magnets. So you are waiting for the magnet to have done its work before you enter. That is another logic. This is another logic. A clean level of liquidity that market is almost close to. Then do what? Look for your trade opportunity to clear the liquidity. So do this. I wish you guys good luck and safe trading. See you guys in the next video.